person in the room.
Yeah.
Should we just do that? Is that cool?
This is pretty great.
All right. 4, 3. Okay. All right, according to my Casio, it is 10 o'clock, so we'll get started. So I'd like to introduce our next presenter here at the Planet MicroCap Showcase Vegas in partnership with MicroCapClub. We have Joseph Thompson from Kits.
All right. Good morning, everyone. Over 7 out of 10 adults require either glasses or contact lenses to get through the day. We started Kits just over 6 years ago to make the whole process easier. We set out to make eye care easy. It's worth it to fix this category. It's about $70 billion, and our hypothesis as we set out was that with vertical integration, we could cut 90% of the cost, really 90% of the waste of making high quality eye care and pass that on to customers. And the convenience of online, you could 10x selection, and we can make goods and ship them in a day. And really that points to our North Star metric of net promoter score and really maintaining 80 plus net promoter score. As we've built Kits, the market seems to be building to us. So the millennial consumer is now, as of last year, the biggest demographic in the U.S. About 75 million individuals in the U.S., about 8 million in Canada, and this year, this millennial cohort is in prime optical age, about 28 to 45 years old, and so using contact lenses, using single vision, coming into digital progressives. This cohort's very unique. They've got very high expectations. What they've told us as we started the company is we've no desire to get into our car or Uber, drive to a lens crafter store, pay $300-400 for a pair of off of a limited selection on the shelf, wait 2 weeks to get them. We want to press a button. We want to get it in 2 days, and we want any company we work with to make it right. And so it's a high bar, but if you can hit that bar, well, this is a customer that'll come back again and again. And this will be the category for the next 10 to 20 years, this millennial cohort and Gen Z, similar characteristics right behind them. And so this is really what we've been building towards. So just over 6 years in, how have we been doing? We've had, we pre-announced Q1, so it's up here. We'll have the full announcement in a few weeks to the market. But we've had about 10 quarters in a row averaging in and around 35% organic growth and continuing to build. As we think about results, we're focused on delivering results up and down the balance sheet. So, results have been, on the top line, have been strong. 5-year CAGR about 35%, consistently growing. As you think about our business, we launched it in late 2018. We had a boost of customers coming online during the pandemic. We took the company public in January 2021 on the Toronto Stock Exchange, and we used 2021 as an investment year to build out our optical lab, to build out our glasses line, to build out our infrastructure, and then we've been benefiting from that leverage and that scale and that mode ever since. And you see the results on top line. Profit or adjusted EBITDA has been continuously improving. In Q4, we were about 6.5% adjusted EBITDA. We've pre-announced we'll be higher than that in Q1 and expect that to continue. And then generating cash flow from operations. As we get more scale, we're getting more leverage on the model. So about $13 million cash flow from operations in 2024. And the magic in this category is once you need vision correction, you need it for decades, often a lifetime. And so that number in the bottom right, 63% of our revenue in 2024 came from repeat customers. And that's even as we were growing organically 32% last year. So this category, can be very almost software-like with its annuity stream. So easy, right? Just find a category that hasn't been disrupted yet. Optical really hasn't had its online or its mobile moment yet. Introduce some innovation and grow. Well, there's a reason so few companies have been able to get to scale in this category. There's so many component pieces of this category. It's it's a manufacturing category. You have to design glasses at scale. It's a fulfillment company. It's a huge technology company. It's a marketing company. There's so many pieces. And so you really need scale to get leverage on the model. You can't, in this category, in our view, be a 20, 50, even $100 million company and really make a dent in this category. And so, for us, we're focused on three things to keep this momentum going. Number one is our foundation. We call this our $500 million foundation. It's our Giga Lab. We have an optical lab onshore here. We built it to scale, well ahead of the capacity that we're using today so that we can grow into it. And it's the machines. And I see a number of folks in the room that have been to our facility. And if you haven't, and you're in Vancouver, come, let's do a tour. It's worth it. You'll never look at glasses the same way again. You'll make your own pair of glasses in the lab. It takes about 20, 25 minutes. And then it's, comes out the other side ready for the carrier network to pick up. And so it's the lab, it's the conveyors, it's the machines, it's the automation that we built into it, but it's also all the data and technology that we built, multiple layers of technology on top of those machines, so that when a customer places an order on kits.com, 5 minutes later, it's rolling off the printer. An hour, 2 hours later, it's made. Your prescription glasses order is made, waiting for the carrier to pick up. And we were having this conversation with someone the other day about the website. We built it, it's all built from scratch. We built the technology ourselves, customized for optical. And we said, if someone were to scrape our site and rebuild it and copy it pixel for pixel, in a week, we would outperform whoever did that, because we're getting over 10 million unique data points every day with the volume that we're processing through the site. And so we're making constant tweaks and constant iterations on the model. Oh, customers are getting stuck in this one little place. Let's introduce some new technology. Let's fix it. Our deliveries are taking a little bit longer than normal just outside of Chicago. What's driving that? Let's get in there and fix it. It's a combination of 100, 1,000, 10,000 micro improvements that just extend them out. So we call this our 500 million foundation. We're currently expected to be in and around 200 million revenue in 2025. We think that there's capacity within the infrastructure, within the CapEx that we've already deployed, to grow to at least 500 million in revenue. And now comes the fun part where we get to grow into that. So the second thing is our unique approach to growth. Our mentality is that the best invention, the best creativity comes from scarcity. And so we cap marketing as a percentage of revenue at sub 15%, even as we've been growing over 30% over the last couple of years. And that really forces the marketing team to think differently. We can't just plug money into the Facebook machine or the Google machine. For us to grow, we have to find new ways. And so a couple examples of this include promotions like first pair free. Our team looked and said, okay, well, to acquire a customer on Facebook or a comparable property would be $100, $200. Well, the total cost of goods sold to make a spectacular pair of prescription glasses in our lab, the frame, the prescription lens, the labor, the shipping, all in is sub $25. So what if we use that cost of goods sold advantage as a marketing tool? And so we'll run promotions like first pair free, where if you've never made a purchase on kits.com, we'll give you your first pair of prescription glasses absolutely free. We'll make the first move because we're so convinced that once you try Kits, you'll become a customer for life. And so customers don't really believe this. They see the promotion, like, nothing's free. There must be some catch. But they see, these millennial consumers, Gen Z consumers, they see the chatter online. I've tried it. It works. They give it a try. Hundreds and hundreds of thousands of customers have tried this. And, that's really where the magic happens from our side. Our team gets the order. The customer places it. Okay, it's a free pair of prescription glasses. Let's see what happens. I place my order. In a month, 2 months, something will arrive from some part of the world far away. Let's see what the quality is like. While our team gets moving, they've got those glasses made in an hour or two. They're flying east from the West Coast at the customer's door in a day or two. And the customer opens their door and they see this Kits box and they're like, no way. I paid $350, $400 for a pair of prescription glasses. It took 2 weeks, 3 trips to the glasses store. You guys gave them to me for free. I love them, and they got there in a day or two. What's the catch? And our team just says the catch is tell everyone you know. And so as a result, the customers really become, every customer that we have has become an influencer for us. And that, there's other promotions that have kind of come out of First Pair Free. Influencers are a big driver. Within influencers, we saw pockets of orders and little movements being formed where these influencers were located. And so the team said, that's interesting. What if we go town by town? And so as opposed to spending, marketing dollars coast to coast, let's isolate on one community. It's really a mathematical exercise. How many millennials, how many people are in a city? 5 million. How many millennials, plus or minus 5 years? Okay, call it 2 million. How do we reach those 2 million people that are our target market in a city, say Chicago? Let's put surge advertising in one market for 2 to 3 months, and let's spike awareness, let's spike trial, let's spike traffic, and then we'll go back to sustain levels. The team can tweak what worked, what didn't, go to the next market, and then the retention team comes in behind, make sure that those customers are coming back for a subsequent purchase. So these are all examples. There's many others where scarcity and really capping marketing as a percentage of revenue has spawned some creativity. It's worth it in this category because and this customer, when they come back, it's a beautiful thing. We're seeing over 60% revenue from repeat customers every year, and even as we're growing. And so there's other initiatives that we have, insurance initiatives. We have an auto ship. We have a Kits Plus membership. More to come. But all of this around this second bucket, which is a unique approach to growth as we grow into the CapEx we've already deployed. And the last area is making sure that we're delivering shareholder value and constructing the company and our financial system so that we're delivering shareholder value as much as we're delivering consumer value. And we've been around for just over 6 years now. I see some folks in the room that heard us talk 6 years ago as we were starting the company. The story has not changed, and 6 years from now, if we're here, presenting at this conference, it's going to be the same story. Number one, focus on organic growth is a key driver. As this market moves online, as the millennials become the biggest part of this category for the next 10 to 20 years, we're not going to run out of market share. Let's focus on organic revenue growth. Number two, do the hard work first. So when we started with a smaller category, contact lenses. And people say, why are you starting with contact lenses? That's not a sexy category. Glasses, much bigger, 4 times the size, much sexier. You're designing, it's marketing, it's really cool. Contact lenses is just commodity product. Well, underneath that is the most valuable part of the category, a young, fashion-focused consumer that comes back every 3 to 6 months. So we built a profit core of vision-corrected customers in contact lenses. And then we built a lab before we sold our first pair of glasses, because all of the profit and the reason why prescription glasses cost so much money is that the lab is largely outsourced. And so as opposed to passing on that cost to customers, we put multiple millions of dollars into the first version of our lab before we sold our first pair of prescription glasses. Go public early. We went public a couple of years after we launched with a full form IPO on the Toronto Stock Exchange, and because it takes a little while. I can tell you, I was definitely not perfect in our first year as a public company, but we're starting to really find our feet now. And so do the hard work first. Invest in long-term channels. Don't invest in growth hacking a specific Google initiative. They change the algorithm, and then you're back to square zero after 6 months. Invest in the customer. That's who's going to spread the word. And then take a non-dilutive approach. And so we've done one equity raise in the company. It was the IPO. We're open to use debt. But we're focused on taking a non-dilutive approach as we continue to build this company. Results help on the top and bottom line. We've seen that come through consistently, and we pre-announced Q1. We'll announce full results in a couple weeks, but anticipating to be another 35-ish% organic growth quarter, and over 7% adjusted EBITDA. And, often forgotten, especially with consumer companies, is a focus on working capital. And that's near and dear to our hearts. And so, growth is great, but it can eat all your cash, in the form of marketing spend, inventory, and CapEx. And so we've been really focused on tightly controlling all three of those areas. I mentioned CapEx has been deployed. We will not need significantly more CapEx to grow this company. We keep a tight control of marketing as a percentage of revenue, and we're obsessive about inventory turns. And so as a result, we had a debt balance with the Business Development Bank of Canada, almost fully paid that off now, while keeping cash flow consistent. And this won't be the case every single quarter, but over time, you should expect us to get more efficient as we grow. And that, we break out our financial statements in terms of fulfillment, marketing, and remaining G&A. And so over time, marketing will, probably be around flat, and then will bend down, and fulfillment and G&A will be the same. We've been thrilled with the support that we've gotten, particularly over the last couple of years from the market. We have 7 sell-side analysts covering the stock. They've been great supporters. We had a bit of a pullback on the stock for a brief period over the last few months, kind of December, January, and February. It's largely corrected itself, and it was a great opportunity for us to get some institutions in who had been really following the name and were anxious to come in to the stock. And then last, and certainly not least, is the team. So Roger and I started Kits just over 6 years ago. Roger has a rich history in optical. He previously started a company called Coastal Contacts. It sold for about $430 million in cash in 2014. It was NASDAQ listed. We have a team, Yves here, who was CFO of that company, runs finance for us now. And we have a team with decades of experience in optical. It's really important to have industry experience in this category, e-commerce and technology experience as well. So why don't I stop there and see if there's any questions from the group. Sure, I think it is reasonable. And so the question is, 5-year EBITDA. Some of the top performers in the category have upwards of 20% adjusted EBITDA. And so, currently we're at around 7%. And, our view is that it's not formal guidance, it's just our internal targets. But our internal targets, for within the next 2 years are to be about a $250 million revenue company, and north of 10% adjusted EBITDA. And then over 5 years, if our growth continues at a slightly slower rate than currently, down to about 22-23%, we expect to be a $500 million revenue company, and I would expect that we should have adjusted EBITDA within 5 years of 15% or 15 to 20%, or even a little bit higher. We've got really tight control of all the dials, and we're just watching growth and profit, making sure they're both growing. We like this, the software metric of the Rule of 40. We love it, even though we're a consumer company. And so we're trying to, stick to that as much as we can quarter on quarter. But we think 20% is very reasonable over the next 5 years. You nailed it. There'll be 3 things that we think will drive both gross margin expansion and profit expansion. Leverage will be a part of it, and it has been, as you saw from the slides. But increasingly, we will have pricing power. We're currently charging $38 for a pair of prescription glasses, including prescription lens, which is very disruptive. And so for us, that investment in a lower gross margin than the industry has is part of our awareness build and helps helps fuel this low marketing cost because people can't help but spread the word about it. But, could we take that pricing from $38 to $48 or $58? Absolutely. And then the third part of that is the repeat customer, which you mentioned. And so typically what we see is first-time customer will come in, okay, I've heard about it, I've seen the reviews, let me give it a shot. They don't do a lot of upgrades. Maybe they spend $50, $60 on their first purchase, and then they wait and see. Well, insurance underwrites a big part of this category. Most, about 2/3 of North Americans have some form of vision insurance, and it's typically in the $300 to $400 range every 2 years. And so, no coincidence, that's why glasses cost $350 to $400. The industry has perfectly mapped the price of one pair of glasses to the amount of insurance that most customers get. It has nothing to do with what the cost of delivering high-quality glasses are. So, the benefit for us when we see these recurring customers come back after 3 or 6 months for their second pair, it becomes a treasure hunt because they've got $400 of insurance to spend. They've only spent $50, and so now we have customers coming back saying, "Well, I've always wanted a pair of prescription sun. I've always wanted that that red pair, that big red pair of glasses, but I couldn't buy them if I could only buy one pair every 2 years." So it'll be a combination of leverage, pricing power, and then increased margin and gross margin on repeat customers. Sure. It's a simple sales channel. We're online only. We've got one store. It's more of a showroom in Vancouver, right on Kits Beach. So our channel is direct to consumer. The biggest, we participate in some of the platforms you could imagine, mostly Google and a little bit of Facebook, but really we leverage influencers and consumers to spread word of mouth. So influencers and affiliates are far and away our biggest channel. We love influencers because influencers are hesitant to promote something if they don't think their followers will benefit from it. And so you really have to be willing to put your whole offering on display and have it be judged, for better or for worse. And then you have to give up total control on how it's communicated out to the market. And so so we love that with our model, and that's been our biggest channel. It's very simple. We have a design team in Vancouver. We source raw materials. We assemble, make the glasses on the West Coast in our lab, and we deliver them to customers. That's it. It's revolving. So it'll be in some areas at different times. We're currently running it in Canada, and then we will pulse it into different markets. We're just getting data constantly. So the data is helping inform us, hey, this promotion, this language worked. When we roll this out to the Northeast in the US, let's do it this way. So I believe it is currently running in Canada, but plans to expand that continuously. Okay, yes. Sure. So contacts is still, we started with contact lenses, still the biggest part. The benefit of contact lens users is 100% of them also need a pair of prescription glasses, even if it's just to give their eyes a break for a day. So we have a lot of overlap on contact lens users also buying glasses as we launch prescription glasses. But contact lens is still the balance of our revenue. Glasses is growing much faster, much faster than contact lenses as off of a smaller base. As we think about kind of 2 or 3 years down the road, it'll still be majority contact lenses. Those customers just keep coming back and have a spectacular LTV. But it'll probably migrate in around 60-40 contact lens glasses over the years. Unit economics on the glasses side, much higher gross margin. So contact lenses typically kind of 35 to 45% gross margin. Glasses is often, if you look at peers in the industry, often 70, 80% or higher. And so we're not at that level, but certainly glasses will be gross margin accretive as we grow that business. Yes. Churn and spend by cohort, absolutely. This is the power of the online business. Previously, I was, before we started Kits, I was at Amazon, and you just saw the power of this data and the moat that allowed. And so we're obsessive about those measuring. It's not something that we make publicly available, but we look very, very closely at churn and by cohort. And what we're seeing is, where we have, just maybe to share a little bit of insight, where we seem to have the best opportunity to add value to customers is increasingly on more premium parts of the segment, because the value delta is so significant on what you'll see on brick and mortar. So for example, daily modality contact lenses, the contact lenses you replace every day, very high value delta, and a great LTV customer is coming back every 3 to 6 months. So we've increasingly focused on that specific cohort within contact lenses. We're seeing digital progressives, which is a smaller part of our glasses business. Those are the lenses where you have 2 or 3 prescriptions within a lens. The value delta is so significant. Those typically cost $800 to $1,000. On kits.com, it's under $200. So, for a customer, even a customer that doesn't want to shop online and that prefers to go to a store, for an $800 savings, it's worth it. And so, yes is the answer to that. We're looking at that very carefully. Churn's getting better, yeah. I'm being told we're done, but we'll be around. Thanks, everyone.